Hey, today we're talking about a very promising company that we've been covering in depth at NetNet Hunter and also on EventDriven Daily. This is probably the best cigar butt that I've ever seen in the decade and a half of buying NetNets. And recently it's turned into a pretty interesting special situation. Today I've invited Iggy from Iggy on Investing to talk about the company, walk you through his long thesis, and hopefully provide you with a good overview so you know whether you want to pick up the company or not for your own portfolio. Now, this is not investment advice, and you should definitely do your own work on the company if you want to invest. We're just here to highlight this as a particularly interesting research candidate. Make sure you see our full disclaimer at the end of this recording. Iggy, how's it going?
It's going very well, Evan. Thanks for having me.
Hey, not a problem. Thanks for being here. You have a really interesting company for us today. And actually, this is a NetNet cigar butt. I'm primarily a NetNet stock investor. And I think that this is probably the best NetNet or one of the best NetNets that I've seen in my career. And I think it would probably be akin to what Warren Buffett was looking for in the 1950s. So good business, really cheap. I know that I own this in my portfolio. You own this in your portfolio, and we've both written up a lot about this on our respective websites. I know that we cover it on NetNet Hunter and EventDriven Daily. But before we get into what the company is, why don't you tell us a little bit about yourself? Who are you? What's your backstory?
Yeah, well, so my name is Iggy. I'm Dutch, and I also live in the Netherlands, in the beautiful The Hague. I'm probably one of your younger guests because I'm 25. I don't know if you know that. I started investing, I think 4 years ago by now. At that time, I was still a student, and I had a little side job at a private bank where I did a simple sales task. But I saw all the bankers, the guys making already a lot more money, investing their private money, and in sort of a non-structured gambly way. So I suddenly saw, oh wait, this is the other retail players you're up against. So there might actually be some alpha in this market. And I had wanted to get into investing, I think, for a long time, but I never managed to pull the trigger. And then, well, at that time, I sort of got the confidence. Also, it was still, I think, the tail end of Corona, so I had a lot of time to self-study. And I basically started investing. Then I think about half a year in, I wrote up another NetNet actually for a stock competition run by Edwin Dorsey, I think is called. He runs the Bear Cave, but he does these sort of competitions for student investors. I was still a student at that time, and I wrote up that stock. It was a small Polish NetNet, so I was never going to win, but I think I did quite well since I wrote it up, because when I wrote it up for him it was 2.7, and I think it roughly doubled, a little bit less now. And also the Polish zloty, I think, had positive development since the time, so the stock did rather well. But I mainly realized that I found this writing stuff about investing very useful and very interesting. So then I also started my own Substack called Iggy on Investing, where I cover mainly small cap stocks, because I think that's both the most fun and the most likely place you'll find alpha as a smaller investor. So sometimes NetNets, sometimes just cheap, so not as focused as you guys are, sometimes special situations. So not my latest article, because my latest article is on Nexo, but before that I wrote on Otto Energy. I don't know if you also wrote about that somewhere on one of your websites.
No, I didn't write on that one.
Yeah. Are you aware of it? So it's also this sort of NetNet play of an Australian listed oil and gas thing. They're distributing cash. We actually got the announcement this morning, which was a little bit mixed, because most of it's going to be capital free, but small part will be a dividend. So we'll have some tax leakage, but that's a NetNet. Like I said, I wrote about Monari, NetNet. I own some banks and insurers, which are also very similar to what Buffett would do. Great Greek insurer that's publicly listed called Interlife. NLB, great bank in Slovenia. That's just because the share structure is weird, quite undervalued. You get something like a 7% yield, I think, on that stock. Stuff like that. So if you're interested, follow me on Twitter on Iggy on Investing, and you'll also find my Substack under the same name.
So how long have you been investing for?
Like I said, I think around 4 years, so not that long. I'm not one of these, it's very American, right? Where people go like, when I was 11, my dad bought me my first stock and I've been hooked ever since. In Europe, basically, my parents told me shares were evil, and only when I left the house, I could start secretly investing in stocks. And it's very different over here, I think.
Your parents were communists then, I guess, the whole Communist Manifesto thing.
Not really, but in Europe, people are really, really scared, I feel like, of listed equities, right? Because I think also, so I'm Dutch. The Dutch have, I think, one of, if not the highest saving rates in the Western world. We save more than 12% of our income. And none of these people I know put any of that stuff into shares. People have large, well-funded pensions that have shares in them, but privately nobody owns shares, even though it used to be very tax advantaged in the Netherlands. Will likely change, but people are just sort of scared of stocks, always have been.
Yeah, well, I know you guys had the biggest stock market bubble in history, I think. It was either the Tulip Mania or the South Seas bubble.
That's the
That
tulip one.
was the
South Sea
largest.
bubble is in the UK. Indeed,
Yeah,
the tulip one is when the VOC
right.
became worth like the entire market cap of the world or something.
So did the whole attitude towards investing in the Netherlands kind of go sour after that? Is that kind of where it comes from?
Mm, I don't think so, because it's too long ago, right? That's 400 years ago. Maybe it's a Europe, because it's most of Europe, right? Maybe sort of the destruction of World War II played a role, because I don't know if equities did that well if you started investing pre-1940. I've not looked at that history. Maybe it's because we're a bit more of a class society, so people think stocks are something for the upper class, and middle class people just put their money in the bank because you need insider info or something.
Interesting. Yeah, that's
We
all
have less
really
of this
interesting.
can-do attitude, right, where anybody can get rich. So people in the middle class just put their money into savings and play it safe, so to say. Where in the US, I think people shoot a little bit more for the moon.
Yeah, I mean, that's definitely my attitude. It seems like one of the best ways to get ahead in life is to buy good value stocks and just kind
Absolutely.
of climb the wealth ladder that way. So definitely that's where I'm coming from with it. But I never really got into it from childhood. Actually, I had to struggle and find my way into it the long way, the hard way, by figuring everything out myself. And then it was only in about 2010 or 2011 that I really found net nets and deep value investing and everything and how well that works.
Not a bad
But
time to start. I started at the peak of the Corona highs in 2021, so I've
oh
only
wow.
discovered hard markets. I think I would have liked to start in maybe 2010 or something. It would have maybe been some easier learnings.
So what company do you have for us today?
Yeah, so as you alluded to already, we're going to talk about a Nexo Group today, which is a net if you sort of account for the receivables as sort of net current asset value, which you should do. It's a very, very peculiar company. I've not found anything in public markets that I think is very similar to it, because it's a credit hire firm in the UK. And credit hire basically means that, well, credit hire and litigation, but credit hire is the very peculiar part, which is in the UK, in the UK case law, there is this special case that if somebody has a no-fault accident, but is minimally insured, so their insurance will not give them a replacement vehicle in an accident, a third party can come in. This is a credit hire firm, and these people are allowed to give a replacement vehicle to these people, but at much higher rates, because they theoretically run this risk of these people not repaying for this credit hire vehicle because they're called impecunious, which is sort of a posh British way for saying poor, I think.
Flat broke.
So because of this extra risk, you're allowed to charge exorbitant rates for providing this vehicle, and these rates you can then, via the legal system, get back from the insurer, from the at-fault party, basically. That's basically how they source most of their claims. So people with an accident come to them. Then they also have their in-house legal firm that attaches other claims. So, well, whiplash is not allowed anymore, but any other health or damage-related claims, maybe loss of income, because they do a lot of taxis and delivery drivers, etc. So they sue for that. And then in the end, after they conclude with the insurance party, they get their money back. So they fund up front and they get their money back. But it's a very unique model, a little bit weird to understand also for how they account for it.
This episode is brought to you by EventDriven Daily. If you're spending too much time trying to uncover special situation stocks, make sure to look at EventDriven Daily's Morning Brew newsletter. Each month, we scour the internet to find as many special situation opportunities as possible, and then send each and every special situation to free subscribers in a neatly packaged email. This service is absolutely free and will save you hours each month trying to source special situation ideas. Go to www.eventdrivendaily.com and look for the subscribe button at the top of the page. That's www.eventdrivendaily.com. I looked back at the company's history. I did a big research project on it. I wrote a big research report, and they had quite a good record of growth going back, I think 8 or 9 years or something like that, into the early 2010s.
Absolutely. So the longest I've looked back is the numbers provided in the Go Public, the IPO document. I think they started in 2015. And indeed, if you start 2015 till now, they have grown almost all relevant metrics at above 15%. So I have here revenue CAGR almost 19%, gross profit 18%, operating income 16%. And then I think this is a company a lot of people will value from a book value perspective, and that has also gone up roughly 15%. There's been minimal dilution, I think 1% a year. It's not something you really like to see if a company is very cheap, but you also get a 2% dividend. So I think those two even out a little bit, although I would prefer to see, of course, less dilution.
More buybacks.
Well, with the current situation, as we'll get into, I don't know if I want them to buy back stock. That's a bit of a controversial issue.
Yeah, definitely. One thing that got me kind of interested in this company is the new, I think, housing disrepair division that they launched or they recently got into, and it seems to be growing quite fast. Can you tell us a little bit about that?
Absolutely. So when I gave you the introduction of the company, I basically covered the two biggest sort of lines the company has, namely this credit hire legal engine. They report them separately. I think they're joined at the hip. But starting 3 years ago, they split out a new section of their legal firm called Housing Disrepair, where there was a new law passed in the UK where it became easier for housing tenants to sue their landlord because of problems with their housing rental. So think mold, damp, broken boilers, etc. Many landlords did just not repair this. This is, by the way, not evil capitalist landlord. This is mainly city councils and social housing consortiums for any people who are very against private landlords. Also, state-run entities, just in their incompetence, tend to not repair stuff in time and provide horrible housing conditions. But basically, the UK government said enough of this and made it easier for these tenants to sue their landlord to make sure stuff gets repaired and get compensation for the time they lived under sort of inhumane circumstances. So Nexo pounced on this opportunity mainly because in their CRM system, they had all these impecunious clients. So these were also likely to live in housing disrepair. So in this way, they could sort of start their kickstart their acquisition engine sort of for cases. And where, for example, credit hire, where we lay out the cash for the hire, the legal process, etc., takes roughly 24 months. And of course, the big capital outlay for the hire vehicle, this process only takes 7 to 9 months, and you only have the legal fees you have to upfront. So it's more capital light, and it has even a quicker capital cycle for the minimal capital you put out. And it's new, and this has just meant that Nexo has been able to grow this division very quickly, and it has excellent ROE. So I think the historic ROE for Nexo, as we have said, is we've grown a little bit more than 15% while retaining most of our capital. Housing disrepair has a return on equity of, I think, above 50% and also something like a 50% margin. So it is an excellent business, and it's growing faster than the other business lines. So over time, you would assume that actually Nexo's return on equity with the new and improved mix will in the future be higher rather than lower. And that's completely not priced in the market. The market has this as a deep discount to book, as if this company will not earn their return on equity, which just seems irrational given the growth of this housing division.
I mean, it's definitely priced like it's going out of business, so it doesn't make sense whatsoever.
Yeah.
What are the basic stats in terms of valuation for the company?
Depends a little bit how you look at it. If you just do the last reported numbers, I think by now we're slightly under 50% book and something like a 5 PE, but I think all of those actually understate how cheap it is, because last numbers are almost 12 months ago because we still don't have the full year results, and the first half year is almost finished. And there are some things not stated in book value because, for example, a fourth business line we also haven't mentioned yet is that they have been doing these cases for the Dieselgate scandal. So if you know, mainly German manufacturers, but many European manufacturers had false claims around the efficiency from a pollution perspective of their diesel engines, sold these cars to people under false pretenses. This all got out, and now all these companies are getting sued. So Nexo has invested actually huge amounts of money in sourcing these cases, preparing the legal work, etc. But because such a thing is always uncertain, you don't account for it in book value. But I think as an investor we should, because they settled the Volkswagen case. The other manufacturers they have, Mercedes, etc., have already settled in other countries. So, and I mean, we know they're guilty. So we should account for this. If you sort of look at the Volkswagen case that had 12,000 clients, was worth in the end 7 million in cash profit. We have more clients for the other companies. That brings that sort of to a cash value, I think, of 20 million. If we discount that to the present day, I think you have to add 15 million or something. Then I said, we also have years of profit we don't know about. That's, I think, another 24 million. So I actually think book value is around 200 million today, if you properly account for it.
Right.
Company last I checked is trades for, I think, 70 million pounds. It moves around a little bit. So I think we're roughly 1/3 of book. Then also the profit margin for many reasons has sort of short-term been under pressure. I think if you normalize operating margins, financing costs, will make again this 15% ROE or better. Well, if you apply that to 200 million, 15%, that's almost 30 million of after cash earnings, right? That's a P of 2 if you normalize earnings. So this company is incredibly cheap. So that's
Right.
a 2 PE for a company that has historically grown well above anybody's cost of capital, right? 15%. You need to be indeed Warren Buffett or better to say that 15% does not meet your cost of capital. So
Absolutely. So, this company is so cheap, it must be a breath away from bankruptcy. What's the balance sheet like?
balance sheet is a bit complicated, at least sort of counterintuitive, because it's very low cash, because any cash they have, they tend to roll into new cases. That's also why they grow. But then you have this huge swath of sort of receivables. So that's casework already performed, but the cash not yet received. And they fund that with a little bit of debt, but I don't know if I have the numbers in my fact sheet. Actually, I do, but I don't know where they are. But I think currently debt is a little bit higher than historically, yes. But our debt to equity ratio is only 0.35, so a little bit more than 1/3 of our total assets is funded by debt. I exclude the leases because Nexo has very good working relationship with the likes of Hertz or other leasing partners. They can basically return the lease at any point. So I wouldn't worry about the leases. They're also small. They just have this debt stack, roughly 56 million. But that's only 1/3 of equity. They can manage cash flows very actively by not writing new cases once you receive cash for the old cases. So this thing is not at all close to going bankrupt. I just think it's very misunderstood in the market from a pricing perspective.
And it has a massive amount of current assets. I mean, you look at it and there's a lot of receivables. I know the receivables are owed by insurance companies and also by governments or government bureaucracies. So it's not like they're lending to a bunch of, risky no-name firms. So those are pretty good. I think write-offs have also been fairly low throughout the company's history as well. So the value of the receivables is definitely top-notch. And I'm kind of talking.
Interesting thing on the write-offs. This is a bit technical if people want to know. The write-offs actually overstate the real write-offs because of the way they account it. So we have this theoretical future value of these cases on our books. If a case is lower, we write it off in the receivables. So you see it as a write-off. Any case that has more uplift than what we accounted for, we don't write up because it's at the moment that happens, it's a cash expense, so it doesn't go through the receivables. So we only write off, we never write up. So write-offs actually overstate the actual write-offs the company does. Another peculiarity about these receivables is that in many cases they understate the future value, right? So I already said we don't have any value recognized for the emission litigation. Second part is for the credit hire, we do register receivables the moment we give the car to the person, and then we account for future win rate and the settlement rate, etc. So that we realize over time. That seems quite matched with how we actually do business. For the litigation, because it's no win, no fee, and there is some uplift fee on the one amount, we recognize we recognize a minimal value once there's an admission of liability. So that's a court minimum of legal fees we can recognize. So that's very small. But all the money is made on the win fee at the end of settlement. And this win fee is never accounted for in the receivables. And that's our biggest profit source. So actually the biggest profit source is not accounted for in the receivables.
Interesting.
So I would say the credit hire, it's fairly accounted, but because it's in the future, you might want to do some small discounting because indeed we're quite sure we're going to get it, but it's 1-2 years out. And they don't actually do this sort of future cash flow analysis that you would do as an investor. So I would say discount that a little bit, but then realize on the other hand that none of the win fees for legal are included in this. So they're actually understated. So indeed, I agree with you. These are receivables to strong counterparties. We know how to collect them. We have a history of collecting them. And they're actually understated because our biggest profit engine, the legal work, is not fully accounted for in these receivables.
So why is this company so cheap? You said it was misunderstood, but I mean, you explained it all to me. I get it. If I get it, then pretty much anybody else can get it too if you're investing. You know, they have a bit of debt, and I know the interest rates on the debt have increased since 2020 quite substantially as, rates generally have increased. So they're paying more in debt. That's kind of suppressed earnings a little bit. But I'm not really sure why this company is so unloved in the market.
There are multiple things I think we have to think about. Let's start off with it's listed on AIM. I think many people have just soured hugely to AIM. Worse than being listed on AIM is that it's an AIM-listed legal company. I don't know if many of your readers know, but there are two legal firms listed on AIM that went belly up, both Rosenblatt and Inns Group. The major shareholders and founders of Nexo were actually also huge funders of Inns Group, so they lost a fair bit of change there. So I think people have really soured to this sort of publicly listed legal entities on the AIM market. I think Nexo is a very different model than these two firms that went bankrupt, because the two firms that went bankrupt both are much more classic law firms, right? High profile cases, a lot of importance on the network and the skills of your partners. So I think these partners extract too much. It's more about their ego. And if one of them walks away, your company blows up. So Nexo is much more about simple standardized cases. It's much more a model than actually a legal firm run by partners. Then indeed, as you mentioned, earnings have been under pressure, I would say post-COVID, and that has, I think, three factors that all should over time normalize. I would say inflation is a bit of a problem for Nexo because we fund cases today, we get the receivables back in 2 years. I don't think you can say to an insurance company, oh, I want to settle higher because there was this much inflation and I had to wait 2 years. That's a bit of a hard discussion. As you mentioned, indeed, the funding cost and the funding costs have mainly risen because of these litigations against the Dieselgate people. Mm-hmm. And we don't recognize any revenue for that, but Nexo expenses all its cost. That goes for all its business lines, by the way. So we don't match revenue and cost as a normal company would do, but we just, any cost, the minute I spend the cash, I recognize it as a cost. So that sort of presses down the operating earnings. Meanwhile, we fund that with debt, which is quite expensive because, I don't think many banks want to get involved in funding litigation. Probably central bank rules don't allow you to count that as actual capital relief. So banks are very worried about funding litigation. So you have to go to specialist litigation firms for the financing. And that's just very, very expensive. So indeed, they had one loan that was I think central bank rate plus 13%, with the central bank rate at 4.5%, that was something like 17.5% cost of capital for their latest debt. They have refinanced this and stated that the cost of capital will be much lower, but they've also not announced what this debt cost is. But also this cost of capital, I think, should normalize a bit over time. And then the last thing that I think has hurt the company a bit is that credit hire is still a very major part of the business. But post-COVID, there have been some court delays in the UK, so in the civil courts where Nexo would normally settle. And this has just made their working capital cycle slightly longer than it was before. So right now I think we're at 24 months, or they say something 18 to 24 months, the last I've checked. And it used to be a fair bit shorter. It used to be 1.5 years. It's been pushed out half a year. That just makes your IRR worse. And it suppresses earnings because of this way we account, right? Because we put all the cost up front, and only upon settlement we receive the final uplift from the legal part. So that has indeed temporarily suppressed earnings. As I said, I think it's quite clear some of those things should revert over time. And then, and then we have, being an AIM-listed legal firm is just not something people are all that into nowadays.
Not quite trendy. So I also noticed that, going back a year or so, they took a lot of their vehicles off the road. What was that about?
That's the last part about people not understanding this business, I think. Because basically, I think the shares had already been under pressure, and shareholders started running, saying to the company and to the CFO, we want to see that you guys are cash generative. But of course, the company is not cash generative while it's growing, right? Because any cash we get in, we get a new vehicle and we grow our credit hire business. Huh? We put any capital we have immediately into new cases. So we have cash work. Basically, to prove to the market that they can produce cash and manage cash, I think they sort of held their horses a little bit on credit hire. But I think there was a 2023 thing. So indeed, 2022 average vehicles was, I think, around 2K on the road. Then in 2023, they took it down a little bit, to raise a bit of cash. But
that's in calendar year 2023?
Yeah. And then I think in the last half year we have reported, so that's actually quite long ago already. So the first half of 2024, they took the vehicle count up again, which is, I think, what they should do. I think there are many misunderstandings about this company, that they should run it for cash, etc. I think if you have the opportunity to grow at 15% a year, even with the shares trading cheaply, it's probably just a good idea to keep reinvesting.
So basically, they just took their foot off the gas to let some cash flow catch back up.
Exactly.
And right. And then they were also blaming, I believe, the lack of cash flow on needing to get those big loans to fund the Volkswagen case, I believe it was, or the Mercedes case.
Yeah, so they have many cases, right? So Volkswagen was settled in 2023, so they actually had a decent cash inflow from that. But then you have Mercedes, Vauxhall, BMW, and I think Renault or something they've mentioned. I might be wrong on the exact names, but they have basically anybody who's guilty, they have in their case portfolio. So they have 4 or 5 cases still going. So that takes capital, also because there's no natural way to get these people. So you have to pay for advertising. So there's a bit more acquisition cost to these people, but the uplift at the end tends to be quite large.
Right. It's very lumpy.
But anything they do requires capital. There's not even the housing disrepair, which is capital light, right? 50% are very excellent, but you still need to upfront the legal work. So if you grow, you need to hire more people. Those people don't want to be paid in 2 years. You have to pay them now. That's just how the business works.
Yeah, absolutely.
And I don't know why the market is so picky about that, because if you produce the right ROEs, it's very worthwhile to keep growing.
Yeah, absolutely. So what impact would getting those vehicles back on the road have? Because, we got one report in, but we were still waiting, I guess, for the full year 2024 numbers, which is, like you said, many months ago now.
Yeah.
What impact do you think getting those vehicles back on the road would have on earnings and revenue?
Well, hard to say, but the most obvious sort of impulse would be is that you have a bit of operating leverage, right? Because they take vehicles off the road. I don't think they fired any solicitors during that time. Yeah, that's also why I think the marks were a bit wrong in pushing them to do stuff like this. Because look, on a spreadsheet that looks nice, but in the real world, if you liquidate capital, you also have to fire people. That ruins your reputation as an employer, etc.
Right.
So indeed, I think there's a bit of operating leverage where the caseload per sort of legal person you have under contract is just higher. So yeah, it should improve operating leverage for sure.
So if we take a look at the business as it stands now, you got the credit hire division, you got the housing disrepair division. Housing disrepair is growing faster. It's far more profitable, less capital intensive, more cash flow generating. And this is basically just going to grow and become a bigger part of the company over time. And then you have also the impact of AI, because one of the occupations or careers that the experts say that is going to be going by the wayside is lawyers. You don't need as many lawyers thanks to AI. So in theory, they could employ AI and reduce their headcount and become even more profitable.
Absolutely.
So is that kind of what you're seeing as well for the future of the business?
I think so, because like we've said, they have much more sort of simplified caseload compared to other legal firms, right? They're small, repeatable cases. So the level of standardization makes it, I think, an excellent place to start with AI. It's a very simple very simple branch of legal work, I think, to start in with AI. And I think they've already said that they use a little bit of LLMs in places. It's not at all needed for the thesis to work, by the way, right? Because even under the current model, I think they produce excellent returns on equity, etc. So it's not something my thesis is based on, but absolutely, I think over time you would expect this simplified caseload to require less and less solicitors, so your operating leverage there should increase. But it's just not needed. But it's very nice to have, right? So you have a lot of upside optionality that's not needed. We're not paying for this. This is not... Well, I never followed the large cap growth names, but I mean, there were many of these things, right? AI-based lending things in 2021. They go to the sky, and only if they actually also hit the sky, the stock is worth something. Even in this company, if they decide not to innovate at all, even though they've already mentioned that they have been integrating LLMs, the model works. It doesn't require AI at all to work, but it's absolutely great optionality for the future.
So if this is a great business, I should say this is a law firm. They've built a great business over time. So that must imply that they have a really good C-suite. What do you think about the top management?
It's a bit of a mixed bag. I think I'm a bit more positive than other shareholders. Many people by now, also because of the offer that's going on, that I think you are aware of, many of your listeners are going aware of, people hate Alan Sellers, the CEO and founder, a bit. But like you said, indeed, I think they built a good company. They've grown it over time. They have been very opportunistic in pursuing new areas, which they have made a lot of money in. I mean, Alan Sellers started this credit hire stuff when he could. He made a lot of money off that. He merged this with a law firm, which created a better model than the other ones, because you have cheaper acquisition cost by combining the two. Then he started the housing disrepair when that law was passed, using his existing CRM base, so having an excellent kickstart in that and building reputation there, which I think gives them a very strong position. And they also realized, because they have a lot of people in their CRM systems and what type of car they drive, they could kickstart the emission litigation, which also seems to have decent IRRs. So I think in terms of doing the opportunistic side of business, he's actually a decent operator. In communicating with the market and around capital allocation and sort of running this public company, I think him and the CFO have struggled a little bit. They also did a little bit of a rotation. So when they went public, Mark Bringel, I actually don't know how to pronounce his name. Do you know Mark Bringel-Low?
No, I'm not even going to guess.
Okay. Well, this Mark guy, he was the CFO for a long time, and when they went public, he was also the CFO. Then I think him and Sellers tried to set up another vehicle to do sort of what Buffett Capital does, I think, sort of larger claim funding. So he went away, and they had, in the 2 years he was away, two different CFOs who both sort of didn't grasp the business or didn't get along with Alan Sellers. So you also had this sort of carousel of CFOs, which is not pretty, basically. Actually, the second guy, he was only on one earnings call, but I sort of liked the way he spoke as an investor. He seemed very aware of sort of the catchphrases the market like focusing on return on assets, return on equity, stuff like that. But Mark came back. I think Mark does understand the business very well because he's been involved for a long time. But just neither of them seem to be that good in communicating with the market. Because, yeah.
So the second guy was a pretty good salesman, in other words.
The second CFO?
Yeah, the guy who knew all the catchphrases, knew what to say.
Yeah, I think so. Yeah. But I sort of liked it because that's sort of what you miss right now, right? So earnings are suppressed, and then we just say operating income was excellent, and we ignored that, or net earnings after tax and ROE were a bit poor for the year. If you explain that well to the market, I think the market wouldn't mind as much. But the communication with the current management has just been a bit poor. But I actually think their execution and their actual sort of entrepreneurial ability to jump on opportunistic things has been excellent. That's something I think sometimes the market doesn't account for enough. We want to see some guy who is a great capital allocator, buys back opportunistically, but a guy who opportunistically goes into new business lines and make money, we somehow distrust. I don't know why that is. I think, as Charlie Munger says, to a guy with a hammer, everything looks like a nail. And I think investors suffer a bit from that. We want to see people do buybacks and special things with capital where there's a lot more to business. I think the other side of business, Alan Seller is quite good at just communicating with the market, and capital allocation in public markets has been a bit lackluster, but I think mainly the communication, because to me, rolling the money into the business is a good choice.
I definitely have a soft spot for entrepreneurs. I like entrepreneurial operators. People start things on the side. I know Amazon, that was a big part of what they were doing over, I don't know, the last 25 years or something like that. They started AWS. And just a lot of different businesses, and it's worked out really well. And so it seems like there's an element here of that same sort of thing with the housing disrepair.
Absolutely.
Now, Sellers has a big chunk of the shares, right? I think he has about a third of the shares, and then there's another activist fund named DBay that has another third of the shares, roughly.
Yeah, so indeed there is DBay, then there are Sellers, and then that's Alan Sellers, the CEO, and there's Samantha Moss, his wife, who runs the legal division. So actually, I think DBay owns 1/3, and then both Sellers and Moss own roughly 1/6. So together, indeed, 1/3. And these three parties together, or two, because I mean, husband and wife are sort of one party, they own 63% of the shares.
Depending on your marriage, I guess.
True. But they seem to be acting in consortium.
Yeah,
There's not yet
fair
some
enough.
sort of succession drama where the two of them are fighting on control of this business.
That's why me and my wife never get into business together. So, yeah, with this activist fund, though, DBay, they must be making some pretty good capital allocation decisions. I mean, DBay must be pressing them, telling them what to do to kind of optimize those decisions.
I haven't been able to sort of discern that. DBay has gotten 3 board seats, so DBay bought also directly from Sellers and Moss. So in the IPO, when Sellers and Moss sold part of their stake, DBay bought some, and then 1 or 2 years after being public, DBay bought some more from Sellers and Moss, and they got 3 board seats in return for being a big holder.
So they were there from the beginning.
It's hard to publicly discern what role DBay has played. Maybe they have pushed Sellers and Moss to raise some of this debt to optimize the capital structure, which has not been optimal. But yeah, we have not seen them push them to do capital returns or to do anything special. So from the outside, it's hard to see what role DBay has played in capital allocation.
Okay, fair enough. And so now, there's obviously a couple of big announcements. Anybody that looks at this company is going to see a couple of big announcements related to possible acquisition. What's going on there?
Yeah, so that's the big kicker with this one. You could also say it has a catalyst, although we're not sure if it is one. Basically, so these 3 parties, the founding couple and DBay, the largest shareholder, who together control 63%, announced on, by heart, the 20th of April, that they intend to make an offer for the company. Also, for anybody who knows, this is because somebody leaked that they were planning to do this. So there's sort of this investigated site in the UK that leaked that this offer was coming, because I think a shareholder found out, tipped off this sort of investigative journalist, and they were forced to announce this offer. In this announcement, they state that they intended the offer to fully consist of either loan notes or shares in a new privately listed company. And I think this set off sort of all the alarm bells with the shareholders, because the stock is very cheap, so any price close to the current price wouldn't work. Much worse, I don't think any shareholder is interested in either owning illiquid loan notes that might be very poorly protected. So they could just put them in a special purpose vehicle, default there, or stop paying or whatever. Same if you get forced into a special purpose vehicle with privately listed shares. I don't think many smaller private investors would be interested in that, because you lose all the protections of the public market. You lose all your liquidity. So nobody is interested in that.
Absolutely. I think the technical term for this would be management takeunder, where they kind of steal your shares out from under you. No obviously breaking of laws here, but being able to buy it at such a low price, or allegedly such a low price, because the company's trading at about half of liquidation value, roughly. You say PE of 5. I think
Again,
I know
that's all
that
non-adjusted numbers. I think if you adjust those numbers, it's 1/3 of book value / liquidation value.
Right.
Normalized PE 2, 3. It's very, very cheap.
Right. And so they're trying to buy this at basically what are the cheapest periods ever for the stock in the last 5-10 years or something like that.
Absolutely.
And they're not going to give cash for it. They're going to be giving bonds or shares in a private company. So they're asking you to trade your shares in a publicly listed, regulated company with a lot of disclosure requirements for shares in a private vehicle that they themselves control. I don't know. It doesn't really seem to add up. It's not that great of a deal.
No. It seems... Well, we don't know the deal, right? So there's been a lot of speculation about this. They were only forced to announce sort of a possible structure.
Right.
Some people have speculated they could not announce cash because DBay is sort of a PE firm. They hold this in a legacy fund. They might need to go back to the owners of their fund. Okay, can we sell this position to another fund of ours? There are sort of conflict of interest things there where you would need to clear a lot with PE. But they're also just opportunists. So it could actually be that they would prefer to pay in loan notes. But indeed, it would be a terrible deal if it's in loan notes. It would likely be even undervalued in a cash offer. So there has been a lot of shareholder resistance to this. Mm-hmm. And I hope that this shareholder resistance will also force them to either make a fair deal or abandon the deal, which seems more likely with the day if I see how many shareholders are against.
I'm looking at their holdings. They have about, we'll call it 65% of the shares outstanding, and the minorities have 35. I think that adds up. I don't know. It's getting to the end of the day for me. But they're going to basically need to get a third of the minority shareholders, get that number up to 75, and then something special happens for them. They're going to be able to take the company private.
Yeah.
So thoughts on that?
Yeah. Maybe if we go one step back for your listeners, right? There are a couple ways this can play out. There are a couple ways you can do a deal under UK law or AIM law. The most conventional way to do a deal is something called a scheme of arrangement. That's basically where you try to get all the shares at once. So basically you say, I want to give everybody X, and if enough people vote for this deal, then that deal is passed, and you basically get sort of squeezed out. So what you would need in that case is 75% of the non-buyers. So the whole minority, 75% of the minority to vote in favor of this deal. And then everybody, no matter if they voted in favor or against, would be squeezed out. You just get what they offered because enough of the minorities agreed that it was a good price. Again, that's 75% of this sort of 35% of the minority. That seems very, very unlikely given shareholder resistance. So if they want to do a scheme of arrangement, which is the cleanest way to do a takeover, they would need to offer a much better price than we're currently suspecting. There is a second thing they can do, which is to just tender for the shares because they already own a large percentage. And if you tender for the shares, you can try and reach certain thresholds. There are multiple thresholds that could be interesting to them. Actually, I don't know this by heart. It's either 90 or 95% you can do, I think, a squeeze out. So then you could also force the last 10, 15% to sell to you. They are very far off from that. So I don't think they're aiming for that. But what they can do is if they reach 75% with a simple 75% majority vote at a special meeting, they could call to delist the company. So that would basically mean that if they tender for shares, they get enough of them, the new shares plus their old shares, they could force this delisting vote. And it seems to be sort of a sword that they're holding over the minorities. So they're trying to pin the minorities, I think, against each other by saying, well, if you don't tender, it's likely that we'll delist, so you better tender, right? So they're sort of forcing us into this little game where if others tender and we don't tender, we have a problem.
Right. So does everybody have to show up to the meeting? So, my grandma with 100 shares, does she have to fly out to the UK and show up at the meeting?
That's actually a good question. I don't think so. I think most brokers will email your votes for you.
Okay.
So I think you're an IRBK holder. I think with IRBK, you just have to email IRBK your preferences. You don't have to go there in person.
Okay.
But not sure on that because I've not been part of many shareholder battles. But I think under modern corporate law, you have to be able to vote remotely, because otherwise you could just hold the meeting somewhere in an impossible place to reach and win the vote. That's probably not allowed.
Our new facilities in Antarctica. We're going to hold the vote there and see if we can.
Or yacht in Monaco. Try to
Right.
find yourself a lifeboat and come party with us on the AGM. That's probably not allowed.
Yeah, probably not. So they had, I believe, until the 20th of May in order to announce some sort of tender or a deal, but they got an extension from the Takeovers Panel in the UK. Can you tell us a little bit about that?
Yeah. Again, not my deepest specialty, but from what I've understand is that once you announce your intention, normally you have 30 days. If this 30-day elapses and you have not been able to finalize your offer for whatever reason, you can request an extension from the Takeover Panel. There must be somewhat of a good reason for this. So in this case, maybe indeed DB needs to get the cash, or there is some minor legal work that still needs to be finished. As long as it seems in the interest of shareholders, the Takeover Panel can extend this deadline. You cannot keep asking for this just to play with shareholders, for example. So the Takeover Panel in the UK is quite a strong body. If it just seems you're playing games by keep dangling the sword, keep extending the deal, that's not allowed. If there's a legitimate reason, you can ask for a 30-day extension. If that elapses again, you would need to have the good reason again to get this extension once again.
Okay, so I think it's pretty safe to say that they're going to do a tender.
I think so as well, yes.
Right. So what happens if that tender is, sees very, very little support? What would you imagine would happen with the stock price? This episode is brought to you by NetNet Hunter, the best resource for net stock investing on the internet. Nets or cigar butts are sub-liquidation value stocks that produced such outstanding returns during Ben Graham's lifetime that he gave up all other strategies to focus on them. Professionals such as Warren Buffett and Joel Greenblatt also launched their career on the strategy, and that proved quite successful to say the least. Right now, you can get a free monthly NetNet stock pick from NetNet Hunter's free newsletter. Visit www.netnethunter.com and look for the link on the homepage.
That's an interesting question, right? Because if people don't tender, they are basically saying the stock is worth more. So, but it's a very peculiar thing. I've talked with some friends about it, and they said even if it stays public, would people want to own this, given that the major investors seem to want to chef the minority? And my thoughts on that are, I still think you would, because the minorities have, in that case, sort of shown that they're not weak, so they will not lose a fight with the majority, because you have some minority rights. If you use them right, we can protect ourselves. Secondarily, I don't know if, let's say, the consortium of DB, sellers, and Moss would want to keep fighting with the minority, because that would only suppress the share price. And I think the main reason they're doing this deal is because they're angry with the share price. And Nexo is a legacy position for DBay that has done terrible for them. They bought that IPO at 1 and 1.5. The stock is now half of that. And
So
basically,
150p is what you're saying?
now 50p, yeah. Now it's 73p, I think. And it's in a legacy fund for them. So they've sold all the other positions, returned the cash, and they just have this annexed to thing because they think it's so cheap you cannot get rid of it. So DBay has a pretty strong incentive to somehow make the shares work. Same for Sellers and Moss. I think just for their ego, they would want the shares to work. If this deal doesn't go through, they cannot force every month a new deal or a Takeunder or a delisting, right? There are protections against this. If the deal fails, they would have to wait another year. I think same for a delisting. You can force something like that once a year, but it makes little sense for them, I think, to every year try this sort of carnival, because it takes a lot of time, even though you could just focus on doing well in the public markets and then all shareholders would be aligned. Right. So there will need to be a little bit of healing of the relations if this company stays public, but at least in my opinion, that seems in everybody's interest. There are some things the minorities could push for to sort of make clear that this healing has happened. For example, with 5% of the vote, you can propose a new independent director that the minorities could choose. Such an independent director would still need the full 50% majority to also be elected, so to actually become a director. So if either DBay or Sellers or Moss would agree with the minority and say, okay, we're going to improve public governance a little bit, we have a new director to also really represent the minority, then I think this company seems again very viable in the public markets. That's a lot of speculation though. It could very well be that the deal just falls through. It does mean that almost all the minorities think the stock is cheap, so we're not that likely to sell. So I would also not expect a big drop or something, because then you would have tendered. But it could just be that it remains a little bit of a standoffish company in the public markets. But it's so cheap that I think that doesn't matter.
Right. So for anybody who's, I guess, bought this year or decides to buy in the coming month, how do you see the stock working out, say, over a 5-year period? You know, obviously the stock price is kind of a crapshoot. What's going to happen with that? Because it depends also a lot on, you know, the market conditions and all that. But the company, I think, should do fairly well. So,
yeah.
Okay. So
let's start from very short term to a little bit longer term. Right? If you buy right now, the first thing you just have is a special situation of the deal. There is a very simple chance that a cash offer comes in that investors think is good enough, and then you just take the cash offer, right? It's very hard for them to right now offer something that's worth much less than 63p. So short term, your risk seems somewhat minimized, because whatever situation plays out, either we all tender, you get a small premium, or it's low notes, nobody tenders, the company stays public. But why would the share price drop if nobody tenders his shares, right? Because we all think it's cheap. Mm-hmm. Indeed, long-term share price prediction, way too hard. But we have this business that has sort of had cyclical tailwinds post-COVID. If those normalize, I think the old business reaches its normal ROE again. So that's credit higher plus legal. That has historically done plus 15%, could even improve with AI. You have this improved mix of the housing disrepair. You have the resolution of the Dieselgate stuff that also has complicated accounting. So the business should have actually cleaner accounting in the future, better cash flow, better return on equity, everything. I think they can keep growing. The company is not that big compared to their market. It's very scattered. So yeah, I think this will be a more profitable, much bigger company in 5 years. Hopefully the share price will also recognize that.
Anything we didn't talk about?
I have some articles about how you can protect your minority rights as a shareholder. You can find those on my blog, so Iggy on Investing on Substack. It's, I think, still my latest article. I'm going to drop a deep dive on the accounting, the value, everything that that might be relevant. In that article, you can sort of see how you can protect yourself in the tender scenario, who you should email to make your voice heard, etc. So if you're already a holder, you haven't read that article yet, I say read the article, follow the instructions.
So where would you place fair value right now of the company?
Of course, fair value is a sort of a very elusive concept, and it's hard to define, but I think, as I also note in my latest article, there are some sort of bottom price ranges you can put on this stock. So as I've said before, I think right now, book value, if you include the last 12 months that we haven't got statements for, plus the value of the emission litigation cases, is around £200 million. Then we have a couple things we know about this company. It has produced excellent returns historically, above 15%. We'll think that will improve with the improved mix of housing litigation, right? I don't think a company earning consistent 15% returns with very little risk. Again, this is not a bank, right? Where you write business good. One bad year, you go bankrupt. That's not the type of risk we're writing. So with 15% ROE, it should trade absolutely at a premium to book in any take private deal where you control this company. Lastly, we see where the insiders did past transactions. So there have been, you had the IPO where Sellers and Moss sold, you had DB buy from Sellers and Moss at some point, and there was a bid from DB in the past at 1.5 that was struck down by the board because they said it undervalued the company. All these deals, so the ones that succeeded were done at a premium to book value, and even the bid that was struck down by the board was as a premium to book value. I think the lowest value that any of these deals had was 1.3 times book value. If you apply 1.3 to a 200 million market cap, you get in the range of 270, something like that, right? And we're today at 63, so many multiples of where we are currently with the share price, I think is the fair value. I think it's very hard to argue that this company should sell below book. I don't know what arguments you would bring. And more than not selling below book, I think it should sell above book. If it did consistently 10%, medium-sized bank doing 10%, something like that, you trade around book. A company that can reinvest at healthy rates, has improving returns on equity, has good historic returns on equity, should trade for a healthy premium to book. And that's just not where we are today. I think we're at 1/3 of book. I think a floor price is 1.3, but likely fair value is much higher. So you have 4 or 5 times upside, I think, in a fair value scenario. The question is just with everything going on, how do we make the market realize fair value?
Right, and I don't expect them to offer 4 or 5 times.
No.
the current share
The
price.
deal, no way. But if it stays public, investor confidence is restored, something like that could be possible in the future. While you wait, the company will keep growing, so this value increases.
Right. Okay, Iggy, so if people want to go read that article, what's the URL?
Yeah, so it's iggyoninvesting.substack.com. Maybe easier is just go to Twitter, Iggy on Investing, and then you will also find the link in my bio.
Okay.
One other thing that I might mention to your subscribers is that if there are any people in Western Europe, especially the Netherlands, Belgium, or something like Western Germany that's close to the Netherlands, is that also on my Substack I organize in-person events for people in the Netherlands, Germany, etc., who are investors. So if you would like to do something like that, because only talking on Twitter or message board becomes a bit boring, give me a follow, see if you can come to the next event, because they're very, very fun.
Awesome. Thanks a lot for giving us this talk, giving us this overview of the company. I really appreciate that.
No worries. Thanks for having me.